afternoon. I was just gonna say good morning to everyone, but good afternoon. Thank you for attending today's webinar. And a lot has happened the past, I would say 3 or 4 weeks that since I first made the presentation. I think the most important development that has happened since then was that after hitting a low of 4,623, which is this is the close because intraday we actually hit 4,100. But we've rallied by around 18%, which is a lot if you think about it, the past month. And I guess the question in everybody's mind is what happened since then, diba? I think I had my webinar March 18, one day before the market hit a low and then rallied. So what has happened since then? First, you saw the number of cases peaking, and this indicates that the worst will be over soon, because inevitably, if new cases are going down, then of course, as more people recover, the number of infections will go down, and this will allow the economies to reopen soon and help economic growth. And there are possible treatments right now that are showing promise. So the timeline of the vaccine being available in 12 to 18 months looks like it will materialize. Secondly, equity markets responded favorably to central banks' efforts to boost liquidity globally. And it's not only in the Philippines, but actually predominantly in the US. And I'll show this more later. And finally, governments globally approve aggressive fiscal stimulus programs, which will be good for the economy. So we'll talk about these one by one. So first of all, as you can see here, the number of daily new cases are peaking globally. So on the left-hand side, you have the global numbers, and on the right-hand side, you have the Philippine numbers. Yes, the infections are still increasing on a daily basis, but as I've said earlier, as the recoveries continue to increase, then inevitably you'll have less infected people. Okay, and then what are some treatments that are showing promise? Actually, there are these top 4 drugs that are undergoing trial with some supportive early data, and most likely these will be the candidates that will be approved very soon. I think the most promising would be remdesivir. Okay, so that one is in the most advanced stage, and hopefully nga in 18 months we will have, in 12 to 18 months we will have a treatment at least. Vaccine parang wala pa. These are all treatments, I think a treatment is already acceptable. At least if you get sick, the likelihood of dying is much less if there is a treatment available. Okay, and just want to highlight the strength of the market really was, of the Philippine market was driven by the US. So as of the S&P 500's close around 2 days ago, it was already up close to 30% from a low of 2,237.4. And the reason why the US market is strong is because of the very supportive US Fed, or their central bank. They've cut rates by 150 basis points. So the interest rate in the US Fed is 0 to 0.25%. The central bank there also rolled out several programs to boost liquidity of banks and financial institutions. And I think what's most important is the unlimited quantitative easing. So in other words, the central bank there can buy as much bonds as they want, and they're not sticking to US government bonds. They're buying corporate bonds, and I think at this point even junk bonds. And I remember the last time I talked about liquidity being a problem in the US and how bond rates have been shooting up. So the Fed has actually addressed that problem by doing their unlimited QE, or by buying the bonds as they were collapsing in price. And you can see that it is actually manifest in their balance sheet. As of I think last week, they already had 6.5 trillion US dollars in the balance sheet of the Fed. And you can notice how sharply it has increased. Can you imagine how it has grown from around 2 trillion during the time of the global financial crisis, up to a peak of 4.5 trillion. That's over 10 years, and then all of a sudden from 4 trillion to 6.5 trillion in just a month. So it just goes to show how aggressive the US Fed has been, and that has benefited the markets a lot. In the Philippines, we do have our own fiscal stimulus. Um, First, we have the 27.1 billion fiscal stimulus addressing the vulnerable sectors, for example, tourism, and then to address the COVID-19 infections, you have 3.1 billion, and then of course the sectors that will be hurt, like agriculture, the laborers, the retooling of employees, etc. And then you have the 275 billion under the Bayanihan Act, the redeployment of the 2020 budget from other items into um, helping people who will be affected. I think the most um, I think most popular, or the biggest portion of the budget will go to the 5,000 to 8,000 peso per month for 2 months for the 18 million households that are in need. Okay, and of course the others would be the purchase of PPEs and to help our frontliners, at least in the medical field. No, um, so aside from that, I think right now the government is working on the transition and structural measures. Still in the early stages, but essentially what will happen is once the lockdowns are lifted, of course you will need to help those that were severely affected, and this would include the MSMEs. Um, and well, the government plans to give them regulatory and taxpayer reliefs and cheap loans, possibly negative interest rate loans, and they also will continue with the build program. So it will be an enhanced build program because the government really needs to spend to boost economic growth. So tentatively, they're looking at 1.3 trillion, or six, which is equivalent to 6.9% of GDP, and this will be spent over the next 3 to 4 years up to 2023. But still, this is in the very early stages. I think they will be talking about this once they resume the sessions in the government. Okay. And of course, we have our own monetary stimulus. Our own BSP cut interest rates by 125 basis points here. So the policy rate is now down to 2.75%. Our reserve requirement ratio for the banks has been cut by 200 basis points this year to 12%. And the government said that, or sorry, the BSP said that it would purchase up to 300 billion worth of government securities. Okay, so our very own QE program, so to speak. Okay. And the good news is our government has the fiscal and monetary space to do everything that it's been doing. So our debt level is actually very low as of end 2019 at only 41.5% of GDP. It came from 74.4% in 2005. And during the time of the global financial crisis, we were at 53.9. So really, we're so much better right now. And aside from that, our government has monetary space, or the BSP has monetary space. Although the overnight rates already look low, I think the reserve requirement ratio still has room to go down because it's at 12%. And our neighbors are actually already below 10%. So the BSP actually said that it plans to reduce the triple Rs further in the second half. Overnight rates, it said it will cut it, but I think that might not be a priority at this point since it's already at a very low level. And it said that it may actually increase bond purchases, or QE, by another 200 billion if needed. So that would really help the economy. Okay, that said, despite all the good news, I'm not really very bullish that the PSEI's recovery is sustainable, at least not in the short term. And this is because I feel that the economic impact of COVID-19 will be severe. So I remember earlier on I said how I felt that it would be a V-shaped recovery. But now if I look at all the data, or after seeing all the data out there, looks like the recovery will be more like a U-shaped recovery rather than a V, and I will discuss this in more detail later. Valuations, yes, I agree, they're cheap compared to the historical average, but they're still far from past bear market bottoms. So I will show you the data later. And another main concern for me is that foreign investors remain net sellers on a consistent basis as the market is going higher. Okay, so the COVID-19 pandemic will really have a severe economic impact. As you can see, the advanced indicators, the Purchasing Managers Index is showing advanced reading that there will be a contraction. So anything below 50, when you read the PMI, anything below 50 means that there will be a contraction. And in the US, it's 27.4. In ASEAN, you can see that it's really below 50. The Philippines actually is 39.7. So the outlook is quite negative. And if you look at economists' forecast, you will see how, for example, the global growth from 2.9%, economists are now expecting it to contract um, conservatively by 0.9% and aggressively by 3.9%. Even Philippine economic growth earlier on, you can see pre-COVID-19, economists were expecting a growth of around 4 to 7%. But now you can see that the possibility of a recession is already being highlighted by economists, and even our own government officials are highlighting the possibility of a recession. Okay. So why am I now saying that our economic recovery will look like a U instead of a V? First of all, our economy will be reopened in phases. It's not going to reopen all at once and everything will be back to normal. No, it's not turning that way. Secondly, our consumer confidence has turned negative, and I will show some survey results to indicate that. And finally, business confidence has turned negative. And this is applicable to global economies and the Philippines. Okay, so first, I think a week ago the government came out with this, trying to explain how they determined whether to allow an economy, or allow an area in the Philippines to graduate to a GCQ from an ECQ. Okay. So you will see that we're still in Manila, we're still in the red zone or the acceleration phase. So I think what will happen is, going forward, provided that you're in an acceleration phase, your ECQ will continue to be extended by another 2 weeks. And of course, they define this acceleration phase is your doubling case is less than 7 days. Okay. But assuming that the case doubling time actually extends to even up to 30 days if your hospitals and your critical care units are at maximum capacity. You can see the top area, critical care utilization rate. If your utilization rate is very high, they will still not get you out of that ECQ. So they're quite strict. Okay, so it's a combination of both. And now I'd like to point out that before you get to the red portion, you probably have to go to the yellow portion, which will probably be another 2 weeks. Then after 2 weeks, there probably you go to the green phase, which is the recognition and preparation. So of course, when you're in the GCQ area, you're gonna be excited because you're gonna think, oh, finally things are gonna be back to normal. But if you look at the green portion, go to number 3, you read that under the recognition and preparation stage, there are still a lot of restrictions. So after you graduate to a GCQ, you will still have a lot of monitoring. In other words, it's just preparing you to what they call the new normal. So they will still observe you for 2 more weeks. So if you think about it, if we are in the red zone and we graduate to the yellow zone here in Manila, at least by May 15, and then June 1, we graduate to the green zone or the recognition and preparation zone. Probably we will go to the relaxed GCQ by June 16. And that said, um, this is just, what is exactly will be what will we look like under the new normal? Is it is the new normal going to be anything like pre-ECQ, pre-COVID-19? These are just some of the key items in the House bill or being proposed right now. First is before you go out, you need to wear masks. Secondly, anywhere you go, social distancing of at least 1 meter when you go out. Public transport, they said uh, tricycles will not be allowed because there's no social distancing happening there. And passengers are going to be 1 seat apart and they will pay through contactless method. In other words, you cannot pay cash. You have to do something like a GCash, credit card, or something like that. Malls and commercial establishments will limit the number of people inside the premises. And in fact, if you are watching the news or going through the tweets, they are even talking about making the air conditioning hot so that they will discourage you from going out. Buffets, salad bars will not be allowed, gatherings to be highly regulated. So, in other words, maybe people will not be allowed to gather, no parties, no conventions. Churches will not be allowed to hold mass for the public. So, the new normal will be not the same. It won't be the same as pre COVID-19, pre ECQ. Okay. And so this is a survey done by BCG, Boston Consulting Group. They asked this question: how do you expect your spending to change in the next 6 months across the following areas? They did a survey in developed markets, and you can see how the priorities have shifted to healthcare, to saving, to food necessities, essentials, versus the non-essentials or discretionary spending. Predominantly the social ones like traveling, public transport, etc., restaurants. People will be spending less on those things. Okay. And locally, they did a survey. The NEDA did a survey. And according to that survey, the percentage of Filipinos who will still buy durable goods or travel in the next 12 months after ECQ is lifted is around 30%. That is based on the outcome of the survey of NEDA. Okay. And actually, I like to look at the data out of China because they're the first ones to have the COVID-19 infection, and they're the first ones to exit a lockdown or to reopen their economy. You can see that although they're optimistic on the right side, that they feel like the worst is over, that they're in a safe place, you'll see that almost everybody says they would try to avoid going out as much as possible, and they've changed their lifestyle and they believe that there's going to be a recession. When you see those kinds of statements, then it kind of means they're not gonna spend money. They're still gonna stay out, or stay indoors and be cautious. Okay. So what will it take to convince consumers to resume previous activities? So there's another survey that they did. You will see that even if the government removes the restriction down here, okay, only half of the number of people will resume their day-to-day activities like eating out, shopping. Okay, for them it's more like there should be no more new cases in my country, and or an available vaccine or drug will be available, then they'll be more confident to go out. and they will, it's back to normal. So long as that doesn't happen, then, they're not gonna do things. So the outlook is quite negative. And for the Philippines, another thing that, like, I'm worried about is OFW remittances. This has been responsible for a lot of earnings growth, or sorry, economic growth. But um, oil prices are down significantly. I mean, if you look at this chart, you kind of can't tell. But we came from $60 and it's now below $20. So that's around a 70% cut, at least 70-80% cut. That's really bad. And of course, the global economy is going through the same thing. COVID-19 is a pandemic. Therefore, economic growth globally is also weak. So OFW remittances in the Philippines are now projected to fall. And the most aggressive forecast is a drop of 18%, which is quite a lot. Okay, business confidence has turned negative. I mean, there are some positives, of course. The companies we've talked to said they won't be laying off people, at least for the first 3 months. For some of them, they said, while we're going through the worst of times, they won't be laying off people. They said they have strong balance sheets. They're quite confident of surviving the crisis. But at the same time, they said we're going to be preserving cash. That will be our priority. Therefore, we will reduce our capital expenditure program. They're not expanding anymore. And then those that announced share buyback program said, okay, since we're saving our cash, we won't be buying back shares anymore. A lot of them. There are still some that do, but most have held back on the share buyback programs. A lot of them are anticipating lower profitability. The problem is at this point, they still cannot give any guidance on how low is low. And they said that although they're not laying off people right now, they said if conditions remain weak even after the lifting of the ECQ, then they have uh, no choice but to lay off people. For the banks, they said they will be setting aside more provisions and they will implement stricter lending policies or be more selective in lending money to businesses. So these developments really are not very optimistic if you think about it. It just means businesses are not going to spend money. It's not good for and it's not good for the economy. Okay. So on valuations, um, I know historically I always show this, and I also point out that valuations really are attractive from a historical perspective. Yes, we are very cheap from a historical perspective, and long-term investors should stay invested. And this really is a great opportunity for those who have not started investing yet to invest in the market. But I just want to point out, although we are cheap historically, um, okay, this one, most of our PSEI members are in a bear market, as you can see. Um, I'm just worried that we're far from previous bear market bottoms, meaning that with the economy expected to stay weak and the market still far from previous bear market bottoms, there is still room for prices to go down. We don't know when or where the market will bottom. But if I look at this table, um, it seems to imply that there is still room for the market to go down. And as you can see, we're now at the 5,500 level. We're at 12 and a half times PE. And this is based on Bloomberg estimates. Okay. And the implied EPS drop, assuming that we're only targeting 15 times PE, is around 23%, which is not as bad as the global financial crisis, if you think about it. But, you know, I do have some issues about it. First is that if you look at the performance of the PSEI members since the start of the year, um, you will notice how the resilient companies, okay, like telcos, pure gold because it's a grocery, um, power companies like AP, AEV, FGen, and the large caps are doing better relative to the PSEI index. Okay, so that's what's happening. Those that are expected to be more resilient or larger cap are being prioritized or are performing better relative to the more um, vulnerable sectors like banks, property companies, gaming, no. Um, and but I think my worry is later I'll show you the forecast of consensus is a little bit high still. Okay. At COL Financial, we actually reduced our earnings estimates and we came out with a report discussing that. I'll talk more about it later. If I look at this chart, this table, um, my biggest worry is some large cap stocks are still expensive. And my feeling um, is a size of market or market capitalization enough to justify premium valuations? Because right now you have stocks like SM Prime and SM Investments doing very well still, because they are the largest capitalized PSEI index issues and they're being bought because of that. Um, I don't know if that's enough to justify their premium valuations. If they actually deliver disappointing earnings, then there's a chance that they will be sold down steeply, like Jollibee, for example, when it released disappointing earnings last year. So just want to highlight that consensus forecast is still very high at this point. So during pre-ECQ, for example, our EPS forecast for the PSEI was 514. We thought that for 2020, earnings would grow by an average of 12%. Okay, today, consensus forecast is 455. There is a downgrade already from 514, but you will notice that the implied year-on-year change in earnings is only 1%. For COL, we were more aggressive. We cut our forecast by an average of 18%. And our assumption was the lockdown would last 3 months. So, of course, it's a very rough estimate. We really don't know what will happen, but we just assume that that would be the case. But during the global financial crisis, EPS fell by 27%. So, although 18% is aggressive coming from a growth of 12%, there's a chance that it's not enough considering how EPS fell by 27% during the global financial crisis. But definitely, I think a 1% decline on a year basis based on consensus is too low. I think they need to cut it even more. Okay. And well, of course, while the market has been going up, the foreigners have been absent. And the question is, can the PSEI sustain its recovery without foreign participation? I mean, in the past, the answer was a no. We never really sustained recoveries without foreign participation. And I'm not sure we can do the same this time around. Total net selling is 20.7 billion since we started recovering in March 20. Okay, and of course we have other risks. Um, One of the key risks that people keep on highlighting is that the virus could stage a comeback, which is why the government is really so careful at this stage. Um, and that would lead to a reimposition of restrictions or a W-shaped recovery. The development of the vaccine takes longer than expected, which for me is the biggest risk at this stage. And aggressive monetary policies lead to sharp rise in inflation and currency depreciation. So just want to highlight why I'm really worried about a prolonged development of the vaccine. This is because, of course, the prolonged pandemic could lead to a vicious cycle. Because the longer you stay at home, the more hopeless you feel, the less you will spend money, the less confident you will be. And as businesses, if our demand is weak, we will become more bearish and spend less on investments. And then we will lay off people, and more people being laid off, less consumer confidence, less spending. It's really a vicious cycle. So really we need to recover as fast as we can. Okay, so at this stage, just like to reiterate our strategy. For long-term investors, it's still a good time to stay invested. Just stay invested. But for those of you who are planning to enter today, I'd like to point out or to emphasize the need to manage risk and don't chase prices. No need for fear of missing out trading, no, or buying all at once. I still think the strategy to buy slowly is the key because again, we don't know where the market could bottom. The investment mindset should still be very long term. Buy today, expecting that you will be holding on to your positions for a long time. Diversify and limit your exposure to an amount that you can keep for the long term. And um, what stocks should you buy today? Should you buy the very cheap stocks? Um, that but could have bad earnings. I think the strategy still should be to stick to the resilient sectors or those sectors that will perform still relatively well even during these difficult times. Okay, so actually we came out with this report a long time ago. You can look for it in the website. We came out with a list of resilient sectors, and um, this is just a list of them. You can review them on your own, but they would include the retailers of non-discretionary items like groceries, drugs, and of course food manufacturers like URCC and PF, and the telcos like Globe and PLDT. Okay, and power companies, I think, um, well, are kind of resilient, but are a little bit more vulnerable. The others here are vulnerable. I think they just put all the slides together. And this is not resilient. Like discretionary consumers will, of course, be affected. And the restaurants, they will be affected because less people eating out. No? And other vulnerable sectors like property sector, banks, okay, we will be coming out with a presentation also on properties and banks, sharing what we learned from the property companies and banks, like how they're coping in light of the pandemic. And that should help you assess or be aware of what's going on with them and why they're going to be vulnerable. And of course, the construction sector, cement, media, and other companies that will be vulnerable to what's going on. Okay, and finally, our stock picks. You can see we're really sticking to the more resilient sectors. And our stock picks are Pure Gold, URC, CNPF, PLDT, FGen, Power Company, which in our opinion is going to be most resilient. I just want to highlight at this point how we came out with our fair value estimates. They're really quite conservative, as you can see. And the reason why our fair value estimates are now much lower is because we, of course, factored in our lower earnings forecast and assumed a 350 basis point increase in our equity risk premium. In other words, when we discount the cash flows of these companies, we are now requiring a higher return, or we're factoring a higher return. So this has led to a lower target price for the companies. So buy below price, as you can see, the prices right now have gone up significantly. That's why we're saying don't chase the prices of these stocks. Wait for them to reach their buy below levels before you start accumulating. For example, for URC, assuming that you want to buy the stock, rather than buy it today when it's 121 pesos, wait for it to go down to 110, then buy it at any level below 110 to protect yourself. Okay, so that's just an example of what we mean by buy below. We want to be able to show a certain or protect you so that you have a certain margin of error. Okay, so in summary, the fight against COVID-19 is showing some signs of success as daily new cases are peaking globally and some treatments are showing promise. coupled with the highly accommodative monetary policies of central banks globally, equity markets are going up. However, we don't think that the Philippine stock market's recovery is sustainable. Even if economies reopen globally, consumer spending is expected to remain weak as consumers continue to avoid public places and worry about a possible recession. In the Philippines, the outlook for OFW remittances remains weak, while most listed companies are planning to reduce capital expenditures. The government will also be reopening the economy in phases and will continue to practice social distancing, resulting to a slower recovery. Okay, although stocks are cheap compared to the historical average, valuations are still far from their previous bear market bottoms. Foreign investors also remain net sellers, and a sustainable recovery is difficult to achieve without foreign participation. So there's a risk that the coronavirus stages a comeback and the development of a vaccine takes longer than expected. Since we don't expect the market to sustain its recovery in the short term and we expect the recovery to take time, we would like to stress the importance of managing risk by not chasing prices, buying slowly, diversifying, and participating, or practicing proper asset allocation. Stick to the resilient sectors as earnings of companies belonging to these sectors will be less vulnerable, even if the ongoing crisis takes longer than expected to be resolved. So that ends my presentation, and I think the floor will now be open to questions. So I'll turn you over to Ed right now, who's moderating the Q&A session.